Um, we had the meeting online and in person at the RDS. The meeting opened with kind of the usual society business, and we held elections for the offices and for the council as well. After that, there was a paper which was entitled 3 Necessary Actions Prior to the Launch of Ireland's Auto-Enrolment Retirement Saving Plan, delivered by Shane Whelan and co-authored by Niamh Paddy, both from UCD School of Maths and Stats. A proposal of vote of thanks was made by Bridget McNally, and that was seconded by Colin Fagan. And then there was a lively discussion after that with contributions including from the Bromhead, Patrick Honohan, Paul Walsh, and a number of others. After that, the President thanks those who were involved and contributed and closed the 176th session. That was it.
Okay, thank you for that. So we're delighted to have today Professor Patrick Honohan, and he's just going to give his talk on, and we get distinctive features of the Irish banking crisis. So you have the floor, Patrick, and we're looking forward to it. Yeah.
Thanks very much. While I rake over this old stuff again, and the truth of the matter is that there's a group of academics and practitioners, central bankers, and the like, who meet every year, usually in Stockholm, to discuss financial stability issues, and they also choose, as part of their meeting, but not the main part, they choose a country study, a case study. So they've been doing this since 2015. I think it's the 5th time because they cancelled for a number of COVID years. And this year they asked me to do a case study, and I chose Ireland. No, they asked me, they wanted Ireland done, and I did it. And so I produced a paper which they wanted to be there as a resource for people to look at. They've done many key countries. They started with Sweden, and they've gone through a number of the key countries. But they haven't done Ireland. I did the case study, and I'm delighted to have the opportunity to talk to you and hear your views about these issues. It's quite difficult to present this material to an entirely different audience to the one for which it was envisaged, but I have, so you will forgive me if parts of it you say, oh, heard all this before, or on the other hand, I'm not interested in these technicalities.
So Patrick, beware, the mic is there to see the owl. So
yes.
If you actually come forward a little bit and then talk to the owl a little, because that's your friend there.
Okay. And what I want to do today is 3 things, if I have time. Kira promised me this would do something if I do something. Oh well, that's fine. I want to talk about narrative. Sorry, I want to frame the story in terms of narratives. The Nobel laureate Robert Schiller, he's talking there. Please don't talk while I'm talking. Robert Schiller says that a lot of what happens in financial markets and in macroeconomy generally is related to narratives that become prevalent among market participants. And these narratives aren't necessarily the true story, but they're a way of framing what's happening, and they can be quite influential. They can be influential for good or for bad. And it occurred to me that we have seen a lot of narratives come and go around the Irish banking crisis, including a preliminary narrative which drove the boom. And then I'll choose 4 subsequent narratives that evolved in the course of the denouement, the working out of this crisis. That would be the main part, but I want to also hit 4 frequently asked questions and tell you where I come out of them. And finally, if there's time, I'll talk about 4 neglected lessons, smaller issues. I'm concentrating on the banking and finance aspects of the crisis. There are wider societal issues that you might want to discuss, there are consequences of what happened during the crisis for other sectors, not financial. But I'm going to concentrate on the banking financial end of things. Well, that's an overall slide, which shows you we weren't the only country affected, of course, in this particular period. And I select out European countries, including the 4 main countries that were hit by banking crises, and 2 that were also hit by banking crisis, but much less in relation to the size of their economy. And you can see there, obviously green is Ireland. And you can see that the amplitude of the Irish crisis is about the worst. It's Spain is close to it. You might say Spain is a little bit bigger in terms of numbers of people at work. So the banking dimension of the Irish crisis is deeper. 2 countries that sort of were damaged more permanently, Portugal and Greece. And then you can see that although the United Kingdom and Germany were not actually helped by the crisis, there was also a downturn there, which was a wider downturn. But that's the context in which we're talking about a very big crisis, and a crisis down is not there. So naming these narratives after Schiller. The first narrative is the sort of boom narrative that was prevalent in Ireland in the years like 2004, 5, 6. It had been building up over a longer period of time. We're talking about the Celtic Tiger and so forth. And like all these narratives, there's some truth in it. That there was the narrative that prevailed was that there's going to be a continuation of the robust growth, the export, productivity-driven growth of the 1990s. Loads of people coming into the country, they'll need to be housed, and people need better houses anyway. We're not a very heavily densely populated country, could be lots more people here, could be like Singapore and so forth. The euro going to have low interest rates, so that's going to help as well. Single market. So there was this narrative that said that any investment you made was just going to be profitable. And so it's clear that that narrative drove the boom. But then it was succeeded very quickly after the bust started by these 4 narratives, one at a time. So let me take them one by one. I'll start with the We All Party narrative. And this, of course, is partly true, but it wasn't a very popular thing to say. An extraordinary statement by Minister for Finance, Brian Lenihan. He didn't get any marks for saying that because people didn't want to hear that we all parties say, well, you may have party, but we won't party. But there's quite a lot of truth in it, obviously. Well, what was going on in the party? Let's recall, roll out this chart, which I really like. It has the 6 Irish owned banks, the ones that were guaranteed. Extraordinarily, we don't actually have the numbers, total assets of even the 2 big British owned banks. They published them separately, and nobody seems to have it. There's a big report on the failure of Halifax, Lloyd's Bank, Halifax Bank of Scotland, and the PRA in London. We can't find data for Irish total assets. But anyway, because those 2 banks were very important drivers of the boom as well. But you can see the enormously rapid growth in total assets of the Irish banks, and the particularly, maybe this has a little line, yes, and the particularly strong growth there in the later years of Anglo-Irish Bank. What was going on? They had access to cheap international funding, Irish banks had, and the foreign banks had. They were doing a number of curious things which didn't help them. They valued borrower collateral in a dynamic way based on current prices. So if you're a property developer, you say, well, I like to borrow 100, and I'm actually going to buy something that's it's actually worth 130, putting up 30 of my own. So here's the collateral 130. Then come back the following year, and the prices have gone up, and now that 130 is worth 170. So that collateral that I gave you last time, 170, is worth 170 now, and I want to borrow another 100 because they could have built another. So this dynamic collateral valuation created huge risks, because if the dynamic growth was to go into reverse, suddenly the amount of collateral was going to be quite negligible, which is exactly what happened. Banks underestimated the developers' total indebtedness. So each of the developers were inclined to go to more than one bank. Well, that's understandable, but they didn't tell the other banks how much they borrowed. You'd think they'd ask. They didn't ask because they wanted the business. And there's a wonderful study carried out very late in the day by the central bank, and asked each of the banks, 5 banks, about the 5 biggest developers. Everybody knew who the 5 biggest developers were. They said, how much have you lent to them? And how much do you think the other banks have lent? And you know, what guarantees have you got? Are any of those personal wealth guarantees? So all of these guys had said they were worth X 100 million, and they told each of the banks they were worth X 100 million. The banks were completely wrong about the wealth, and they hadn't verified it. None of them verified the claims of the owners, and they didn't know what the other banks said. They greatly underestimated. They said, "Oh, well, I think he's probably borrowed about another billion from the other banks." No, 2.5. So huge neglect of fundamental underwriting principles. The prudential supervision, well, these are banks that tell us to pay a lot of money. We don't really know much about it, but we'll go in and check a lot of boxes. But it was deferential, it was tentative. And there wasn't much of a regulatory reaction, let alone supervisory regulatory. There was a small increase in capital requirements, but it was quantitatively so small that if you're lending to developers now, you've got to hold a little bit more capital. But it hadn't been calibrated in any realistic way, so that when the banks said, "Oh, what's a new capital requirement?" and they did the sums, should we got that already? We don't need to. So that it was absolutely negligible. So that narrative we all partied has quite a lot of legitimacy from the banking point of view. It actually, though, it created a loss of confidence. I mean, the idea that everybody had been very stupid in business people. How could we have been so stupid? There was a general loss of business confidence in Ireland for quite a few years around that time, which didn't help the recovery. Gillian Tett in the Financial Times wrote an article around, I think, 2009 or so, and she reported on a visit to Dublin, and she said the atmosphere is like going into somebody's flat after a party, and they're lying on the sofa, nursing their head after the hangover. And I think everybody said, yeah, actually, that is exactly how it feels. Let me show you, because I want to show you a lot of numbers, especially since it's the Statistical Society. That's the boom, and we'll see the bust shortly. It's quite a strong boom, as you can see, particularly when this is a log scale. So that's around 100 there, and then it goes up to nearly 400. And that, this is where we bought our house, of course. And people are surprised. This is very high, because this is real housing price. This is deflated by CPI now. This is not just, you know, like Argentina, everything is always going up. And then the other indication of really unsound underwriting practice of the banks, as things got hotter and hotter and the prices are going up and up, instead of deciding that they needed higher deposits for prudence, the banks decided to lower the required deposits. These are loan to value ratios for the 4 years running up to the height of it. The one on the right is for the first time buyers here. So you can see that there only 2004, only 7 or 8% were getting 100% loan to value. In other words, no deposit required. But by 2006, over 30% were getting no deposit. So this is very nice for the people who want to buy a house without a deposit, but it's terribly risky for the banks. They should have been saying, well, the price has gone up this much, gosh, they might come down. And that's not very commonly observed even in places like this. Okay, so that's enough for the boom. What's the next narrative that came into play? This is a side swipe by Lehman. Now, this is a narrative that didn't last very long, but it was held onto by a number of decision makers, and still believed, I think, by some. This is really, everything was sort of all right. We wouldn't have had any trouble if it hadn't been for the failure of the US authorities to rescue Lehman Brothers, which triggered and it's true that it triggered a global financial crisis, but in fact, the Irish property boom had peaked before this, months and months before this. And what was happening was it exposed the weakness of the Irish banks. And there's a quote from the television interview of the head of bank regulation in Ireland. He said, by any estimate, the Irish banks are so well capitalized that nothing bad can happen. It had consequences, though, this narrative that said it's nothing to do with us, it's all coming from America. Because it led, of course, to the blanket guarantee of September 2008, which was recommended by the central bank to the government. Quite important. It wasn't the government saying, we just guarantee everything. The central bank said, we can't think of anything better to do than that you should guarantee, and that you should guarantee everything. This is based on insufficient supervisory experience and the banker over-optimism that we saw. Why do they need to introduce a guarantee? The banks didn't have the cash to repay depositors and bondholders who were just waiting. Their bonds are falling due, and they didn't have the cash to pay. So the banks needed some help, or else they would have to close their doors. What would they do today? What would you do today? What would you recommend today? Well, it's a different world. There are two ifs. If the politicians had realized the damage to the banks was so bad, I'll show you something in a minute. And if they'd had what we have today is legislation for the orderly resolution of a failing bank while keeping essential services going. If you had those two ingredients, there's no doubt that the decisions would have been different. You would say, well, what do we do in a situation like this? Oh, do we guarantee? No, the guarantee is you would intervene in those banks, you would seize control, and you would produce new banks going out of the situation that keep the essential function of banking going while imposing losses on the equity holders and the bond holders. Now, we can see what happens next. One indication of the trouble that the banks were in. Two indications. One is this, which is the price at which banks could borrow in the bond market. That's oversimplification. That's not exactly what this is measuring, but it's highly correlated with that. This is telling you that right here, just at the moment where the guarantee has to be put in, that the cost to banks of borrowing has gone from practically zero over the wholesale, the best rates that any bank can get. It's gone up to almost 7 percentage points more. And the other indicator, oh, that's not the indicator. Anyway, we'll come to in a minute. I thought that was meant to be the banks losing deposits. We'll come to that side in a moment. All right. So that's the second narrative. The third narrative, I would say, came about a year or so later. I'd accept responsibility for this one. Because the picture has changed. I'm not saying it's somebody else's fault. I'm saying this is a bad situation for us, but manageable. So that didn't go down well either. It went down a little bit better than we all partied, but say, oh, I'm manageable for him. Not manageable for me. Maybe I'm manageable for you. But really, the message here is a message to international investors and participants in markets who are saying, what's going on in Ireland? They think they have it under control, but they recognize that it's bad. Previously, they are not recognizing that it's bad. Now they recognize it's bad, but they think it's got it under control. We're not so sure whether they have it under control or not. But let's see what was going on to say that it's bad but manageable. Just some. So here's the housing prices. We saw them going up, going down. They go down, 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 down. Now that might look that it's a very sharp and sudden decline, but there are a lot of years going along at the bottom. And that's one thing that's making it quite difficult to discover whether it is manageable or not. Because if the prices went down in a matter of months and they sort of hit a floor and then started to go up, then you'd say, well, now we see what the situation is. But they kept going down, and you knew they were going to continue to go down, but you didn't know where they were going to stop. So trying to say, well, this is what the total losses will be. Can the state afford to pay on the guarantee, given how much? Because it's very difficult to calculate. And lots of people who are not looking, they don't have much bandwidth for Ireland. They say, why do I have to invest in Ireland at all? I'm just looking at this. These house prices are falling, falling, falling. They could lose hundreds of billions. We don't know how much they're going to lose. They've guaranteed hundreds of billions, so we're not going to get involved in that. There's the rest of that chart on the CDS prices, the cost of the banks. And you can see that even after the guarantee, at first, the guarantee is there. And, oh, no, it's all right. They're guaranteed. And the government, Irish government, is AAA. It's a AAA guarantee. So no problem. So the cost of borrowing by the banks is low, except then people are thinking, wait a minute, now where's this one? Oh, that Irish government, they've closed one of the banks. That was a reaction most people didn't expect. They close the bank decisively, close the bank, close down the Irish bank, nationalize it, I mean, take away the control of that by existing management and the shareholders. But the global reaction was, whoa, bad news from Ireland, bad news from Europe. A big bank has been nationalized. So this is not what we expected. So zoom out again. And then gradually confidence is returning. And then up here, we see another deterioration. What's going on there? Well, what's going on there? Two things. First of all, there's an expiry date for the guarantee. So things that were initially guaranteed will run out at the end of September. So there's a cliff edge where people say, well, I'll lend you this money until September 2010. And then we'll see, because you're only guaranteeing until then. So there's a cliff edge of borrowing. So people in the market say, wait a minute, is the Irish government actually going to honor this guarantee? I know it's in law now, but we don't know anything about Irish law. So we don't know. So it's a bit of a panic. And then the second thing that's happening is, and we all know that one of the measures adopted by the government to deal with it, with the banks, and to put the banks back on an even keel so they can move forward in future, was to take from the banks all of their big property-related loans, to buy them at a tough market-related price, put them into Niamh, which would manage these loans out. Well, that's fine. That was announced in April of 2009. It took until April 2010, at the end of March 2010, for Niamh to make the first purchases. The first purchases, debt of loans were priced at a very heavy discount, much worse than the banks expected, worse than most of the market expected. That was fine as far as it went, but it was only the first few, it's the biggest loans, first 10 loans. Now, what was that going to mean for the other loans? Were they going to be as bad? Could they really be as bad? No, it must be the big borrowers. The big borrowers, they must be the guys who were really priced, just and paid crazy prices for plots and land in Ballsbridge and so forth. Presumably the medium-sized developers weren't as reckless or didn't get as much money from the banks. Well, that's what we thought, but it wasn't true. It was the big guys were crazy but professional. The small guys were just crazy. And as Niamh announced successive sequences of bond purchases, the haircuts, the revealed losses were getting bigger and bigger. And so that's the second reason. And this is all happening in the third quarter of 2010. And at that stage, it was beginning to look as if the game was up. Now, the next one is the slide I was going to show you that shows the run on the Irish banks. I already showed you prices. Now here's quantities. So starting, I only have the data there from the beginning of 2009. So just after Anglo-Irish Bank is. So there, I can break this in many different ways, but I'll just show you one. And this is UK and debt markets. So these are bonds maturing. And then there's the other set of bonds that are maturing there at the end of September 2010. And they're not being rolled over. So this is going down, down, down. A little bit of rolling over here. Confidence is returning towards the end of 2009. But then this news from Niamh, no, I'm not going to get involved in Ireland anymore. And even, what is corporate and retail non-UK? Non-UK, it's Ireland, basically. And corporate, which is Irish corporates. So there is a bit of loss of some people. Smart money is getting out here. Say, wait a minute, I can easily put my money into an English bank. Why do I need to do this around in here? And then the retail money, the plain people of Ireland say, oh, there's something wrong with the banks. So all the rest of the money is going. These are drastic reductions in liquidity. This is a big bank run. A big bank run. Now, well, we'll come to how this is financed. What happened? Where do the banks get all the money for that? We'll come back to that in a minute. Now, one part of the narrative here, the narrative that says it's bad but manageable, starts to come into play when the then official lenders were called in by Ireland in November 2010, the IMF and the European funds. European funds had already for Greece been a different problem. The IMF had said, the European funds had said, first of all, this is bigger than we ever expected. Second of all, we don't know how to deal with a big macro financial crisis. The experts in this are the IMF. So the European Council, they set up various structures, but they said we want to have the IMF involved in its lending. IMF will put up a third, and the European funds will put up 2/3. There's the Troika, the Commission, the ECB, and the IMF. The narrative that said that this was bad but manageable morphed into, oh, those IMF guys seem to have made this manageable. Oh, they were the best. You ever hear somebody say that? Yes, you did. You said if you encountered any middle-class person in Dublin in 2011, you heard somebody saying, IMF, the best government we ever had, which is it's not exactly an endorsement of the Irish political system. And of course, they weren't the best government we had ever had, but that was part of the narrative that was going around at that time. So I want to say something about that and about the role of the official lenders and how good was the program. Well, the first thing I want to show you, and we'll see some interest rates later. Here's a set of long-term interest rates for Ireland and Germany. You see, the first thing you see is way over here before the euro began, Ireland used to even in those happy years of the Celtic Tiger, was paying about 150 basis points more than Germany for its borrowings, which is not an awful lot. Then as soon as the euro comes in, we basically see these lines are sort of coalescing. And then the crisis starts to emerge. You see Ireland decoupling from Germany into 2010. Now, you think that's where we had to go to the IMF? No, that's where we went to the IMF. This one here, this double peak here. So that's the first question you have in your mind. What's going on? Went to the IMF, they lent you a whole lot of money, and the international financial markets will still not lend to you. Is the Irish government borrowing from the markets at these prices? Not at all. Not a penny. These are the trades between people who actually at present, at that time, hold Irish government bonds. These are secondary market deals. And there are some, given that it came down again, there are some investment funds who bought and some who sold. And the people who bought tell you all about it, and the people who sold say, this is an opportunity there. So a number of things were happening to make Ireland vulnerable to this other peak. One has nothing to do with Ireland, really. It's the fear that the whole euro system might break up because of what's happening in Greece and the spillover. There's a spillover to Ireland, but there's also a spillover to Portugal, and it looks like a spillover to Spain maybe coming up. And if why would it stop at Spain? Could be Italy, could end up in France. So a lot of speculation in 2011 and 2012 about the breakup of the euro. So that's part of that. But another part of it is the markets are not impressed by one feature of the best government we ever had, which was the United States. Their interest rates are very high. Why are their interest rates very high? I thought they were meant to help poor countries that were in balance of payments difficulties. Well, yes, they are, but they don't want to lend as much money as they lent to Ireland. They have a set of quantities. You have a quota. That determines how much money you pay in as a member, and it tells you how much money you can borrow at reasonable rates. But if you borrow a lot more than your quota for a long period of time, there are heavy interest rate surcharges. And those surcharges are so crippling that they can make the difference between a debt that is sustainable and one that is not sustainable. Especially when the European funds also said, oh, what interest rate should we charge? Well, we'll use the IMF interest rate. Well, what else will we use? So all of the rates were set at those very artificially high rates. By the way, who do you think is paying those high rates now? Argentina and Egypt, the countries that are paying high interest rates now. Will they ever pay the IMF back? Not unless the IMF lends them more money. So that's the way that works. And where we see that the reduction in the spread here is not just because of changes in the views about whether the euro will survive, but in the middle of 2011, it became obvious that Greece could not possibly service the debt that it had accumulated at these high interest rates. And therefore, it was decided by the European funds that they would not use the IMF interest rates anymore, but they would basically charge whatever it cost Europe to buy, to get the funds, plus a little administrative charge. And the Irish ministers said, me too, Portuguese, me too. And it was understood that it would be pari passu. And so the Irish and Portuguese interest rates came down to something quite low. For the European part, not for the IMF part, because the rule is a rule. So something's good and something's not so good about the program. Here's something that was quite good about the program. It's not a great curve. And I never show Irish GDP because we all know I don't use GDP, but you can't see the heading there. But what this chart shows is for 3 countries, Ireland in green, Portugal in red, and Greece in blue. It shows you what the IMF programs, what the staff projected to happen in GDP in those countries, and how things stood at the end of 2014. And I'm not going to go beyond 2014 because in 2015 we're getting into leprechaun economics and so on and so forth. And you see something terrible here that the IMF said, oh, Greece, well, I'm sorry, you're going to dip for a year or 2, but by the 3rd year, you're going to be very aware and you're heading off in the upward direction. Portugal is going to be the same, generally the same story. But look what happened to Greece. Down, down, down to 83%, and not much of an increase after that. In fact, that 2015 was a projection at that time they didn't make. Portugal, not as bad a gap. But look at Ireland. It's not bad. It's pretty good forecasting. And that's part of the story that the modeling was based on something that could be delivered and was delivered. And I'm not quite sure why our forecasts were better than Greece or Portugal's forecasts. I'd like to think that it was partly influenced by our internal forecasts in the official sector in Ireland. We say, what do you think is going to happen next year? So ask the IMF, we say, here we are. This is what we think. Oh yeah, that looks about right. Instead of, I can imagine some other countries I might say, we will recover. Oh, you're not going to go. Well, let's, you say you're going to grow by 5% next year, but can we say 1%? So anyway, that's a positive dimension of the program. And anyway, to cut a long story short, if you're looking simply at financial viability and whether the credibility of Ireland in the financial markets was restored, well, it was sort of restored. These are the 3 main credit rating agencies. You can see there at the beginning of 2009, there's still AAA, all AAA, just before Anglo-Irish Bank was liquidated pretty quickly in the course of 2009, and especially 2010, especially when the program came in, all those, that steep fall there, that red fall is after the program was announced. That's what I'm saying. You mean they're going to have to pay 5.8%? Oh, it's not going to work. Nevertheless, they're all investment grade except, see, 10 is actually the line for investment grade. So Moody's, who had persisted with optimism a little bit longer than the others, changed their main analyst for Ireland and became very pessimistic and said, actually, the turning point in the interest rate chart is just at the same moment that Moody's became pessimistic. Everybody else became positive. So I'm not sure how useful these credit ratings are, but you can see that after an interval of approximately 3 years, they started to move up again, and now they're not where they were, but they're all AA or so and so on. Okay. Now the last narrative. It started to come when things started to come right. People say, well, everything's starting to, the growth in employment and unemployment is going down, and things seems to be under control. It's at that point when a new narrative comes into play. It's all the ECB's fault. See, they pushed us into a program, and it wasn't necessary. And even when the Minister for Finance said that he was contemplating taking some of the bonds of Anglo-Irish Bank, no longer guaranteed because they'd gone past the September 2010 deadline. So we're thinking not paying those, or not allowing Anglo-Irish Bank to pay those, because Anglo-Irish banks wouldn't exist if it that weren't for support of the government. And going to Michael Noonan, Trichet, the president of the ECB, said a bomb will go off in Dublin if you do that. I don't think he meant that he was going to bring the bomb himself. I think he was going to say, he meant to say that you will lose all financial market credibility. Probably not true, because this stage, Anglo-Irish was kind of a dirty word in any financial market. And yes, people would be a little bit upset that they lost money on bank shares, but that upset would be spread around Europe. It would affect the interest rates on all bank bonds in Europe, not specifically in Ireland. So the bomb might be more like a sort of global warming affecting the whole continent. So this is the narrative that was there. Well, of course, in fairness to the ECB, this shows you how much money the Irish banks were borrowing from the ECB. I showed you a minute ago their deposits falling and their bonds falling. So when deposits falling, they have to have the money to pay. They have to borrow the money. They have to borrow the money from the central bank. Central bank has to check with the ECB. ECB says, yeah, by and large, ECB said yes, but they rattled sabers a bit. They actually wrote a letter as the Troika team were in Dublin planning the ECB were worried. Don't know if Ireland's going to go for a program. We got them to go for a program. The ECB wrote a letter signed by Trichet to the Minister of Finance saying, well, we understand that we'll have another request from the Central Bank of Ireland to lend emergency liquidity support to the Irish banks. I have to tell you that if you don't go into a program by this Sunday, we will not be able to accede to this request. They never actually said no, but they didn't make that threat. I thought it was a bluff, and I told the minister or I told the officials in the organization bluffing. But actually, they did the same thing to Greece 3 years later, and it wasn't a bluff on that occasion. I think it still would have been a bluff. I don't think it made much of a difference. Maybe it's the moment to remind you how much of the losses that the banks took from all these bad loans. It's a rough estimate of the losses that were taken by different players in the Irish banking crisis. Shareholders, anybody whose elderly grandparents were being looked after by dividends certainly knows this story. So from the market, that's not the market value, but from the book value of Irish shares, thanks, 29 billion lost. Remember the neighbor asking me, do you think the bank shares will go up before whatever the other was? It wasn't going to happen either. So the bank shares never went up, and shareholders were wiped out. What about bondholders? Were they rescued? No, they weren't. Some of the bondholders, the ones that shouldn't have been included in the guarantee, took significant losses, partly before the Troika arrived, because they felt there's no way the Irish government are going to pay us in the end, so we'll sit down quickly and make a deal with the banks. And partly after the Troika, when new legislation was brought in, a little bit like this resolution legislation, allowing the government to target subordinated debts. So they lost a fair amount. Our friends in the Royal Bank of Scotland, now NatWest, and Bank of Scotland Ireland, now Lloyds, and a few others, ABC, Danske Bank, they lost a lot of money. And the government, in the end, government laid out more than that, but got back quite a lot. So in the end, probably about 37 billion for the government. So I think it's important to remember that I'm not saying that is the right percentage, but it's not 100%. It's not even 0.5%. So the government got a heavy hit, and it draws attention to the fact that we have two big debts, indebted entities here. We have the banking system and the government, and the debt of one affects the debt of the other. This was misunderstood by the lenders, the official lenders, as the program proceeded. They were concentrating almost exclusively on whether the actions that were being taken to strengthen the banks would be enough to bring the banks up to a healthy situation. But the banks would never be healthy if the government's finances are not healthy. Why? Is it because, oh, the banks are holding government debt? Yeah, a little bit of that, but actually the banks are not holding that much Irish government debt, not compared to in other countries. The point is that if the government's in trouble and is not able to pay its way, it's going to find ways of grabbing money everywhere, including from the banks. So the banks cannot be healthy if the government's not healthy. The government is the essential thing to remain healthy, and that wasn't fully understood by the private banks. Now, just there's 37 billion. So is that what caused all the austerity? No, because the end of the boom eroded the tax revenue from the boom. And it also created expenses in terms of social welfare and so forth. So in order to pay for those, other things had to be cut. So the total, here's a measure of the total amount of austerity, starting with the 2008 budget, which happened just 2 weeks after the guarantee. The banks contributed a lot. Most of that 37 billion was hit in the first year, and that definitely frightened financial markets. But the bank 37 billion was once, and the adjustments of 10 billion that year, another 15 billion that year, and another 15 billion, and another 15. So the steady adjustment every year just to pay for ordinary government business, because the taxes weren't coming in the way they had been in the boom. It's far bigger effect of the austerity. Does that matter? I don't know, but it seems an important point to make. No, I'll have to just see how I'm doing for time. Not well. So I should come to a conclusion. I've given you the four narratives, and that slide related to some of the ways in which novel financial engineering was used to claw back some of the costs from the ECB. The central bank's profits the last number of years very high. They won't be high anymore. And there's some legacy issues, which I'm not going to have time to talk about. Interest rates, the way the banks reacted to the interest rate difficulties. Mortgage arrears, it peaked in 2012 or 2013. They have come down, but they're still not low. They're still not what you would expect in a normal time. And those are residential, and these are the rest of the banking book. And then the four frequently asked questions, and I'll end with this slide. So these are the questions you've been burning to ask. Was the 2008 the best guarantee, the best option? No, it wasn't the best option, but the best option wouldn't have been that much better. So the focus that everybody presents to the on that, what happened that night, is misplaced. It's interesting, but it's misplaced. Did Euro area membership help or hinder Ireland in the crisis? I'm going to say one thing about that. The Euro area had an effect which, to compare, to see what the effect it had, look at Iceland, who didn't have the euro. Of course, they had a lot of chaos in Iceland. But one thing that happened was that their exchange rate collapsed, which meant that real wages fell substantially. Lots of people lost their jobs, but fewer people lost their jobs than would have if the real wages hadn't fallen, because they could still, the businesses that they worked for were still viable. In our case, there were some adjustments to civil servants and public servants' salaries, but by and large, the people who retained their jobs didn't suffer anything like the income loss that people who lost their jobs. There's a different distributional impact. Was austerity too deep? That's the third FAQ. And the answer is, of course, generally, austerity in Europe was too deep. Given that around Europe, there was an unavoidable adjustment. But one can have a reasonable debate about whether it could have been a little bit slower or not. Ashok Modi, who was the IMF desk man, he was pushing for a slower adjustment. You don't need to adjust so quickly. I didn't have a view on it, but I did have a view, but I didn't push the view. My view was no slower than this, because the faster you get out of this confidence trap, the faster you can get back into a recovery mode. But there's room for debate. But the final FAQ is a really difficult one. And you find some people, and it's a little bit like it's all the ECB's fault. People say, maybe this didn't need to happen at all. That this was sort of self-fulfilling. If we had believed, if everybody had believed that Ireland can come through, there wouldn't have been any need for a program, austerity, banks closing down, shareholder losses. I think it's hard to argue this for the banks. I think the banks, the only way you can argue that this was the case is if you think that Niamh did a terrible job selling the assets. Because if you look at it, the total of 37 billion corresponds plus or minus more or less the same as the difference between what Niamh paid for the loans plus the profits they made, the difference between that and what the banks had them in the books. That's hard to get rid of that. But the sovereign, yeah, I think if the ECB had adopted a different approach, it could have probably avoided the need for this adjustment. Whether that would have been a good thing or not is less clear, because when they started to help Italy, the Berlusconi government immediately used this as an excuse to not adjust, make no adjustments. And but this is a matter that's still debated. Now, I'm sorry, I've gone on too long. And I was afraid of doing that, because then you had to present a different presentation to.
Thank you very much. So so Niamh Hardiman, Professor Niamh Hardiman is going to give us our first vote of thanks, and she's from the School of Politics and International Relations at University College Dublin.
Thank you very much, Paul. I would like to propose the first vote of thanks to Patrick. Thank you very much indeed for a really fascinating talk. And as usual, Patrick has given us a presentation that amplifies certain aspects of his fascinating paper, which is itself, as ever with his papers, detailed and really masterly account of some selected aspects of the Irish banking crisis, and builds on other work that he's done, especially his wonderful book, Currency, Credit and Crisis, Central Banking in Europe. And then his most recent book with John Fitzgerald that puts the trajectory of the Irish economy over a number of decades into perspective. That's the title of it.
Europe and the transformation of the Irish economy.
Thank you very much. So what we have here in Patrick's paper is a zoning in on three themes. He says the distinctive features of the Irish banking crisis that he's choosing to present to the Swedish audience of experts include, the highlighted points are the blanket government guarantee of bank liabilities, run on the national banking system financed by a supranational central bank, and the sovereign bank funding cost doom loop. And those three themes are what have generated the storyline that we've seen here today, although he's told the story a bit differently. So in my comments, what I want to do is just stand back from the very detailed investigation and analysis that Patrick has offered in this paper, which I'm sure everybody's read and enjoyed very much. And my reflections are on each of those themes from my own disciplinary perspective, which is that of a political scientist and political economist. Because each of those themes then, each of the discussions in each of those sections has made me think about the broader macro political dimensions of how all this was possible, what we have learned more generally about the political system within which these choices were made with these sorts of consequences, and where we are now. Because this is ultimately why we want to know about it, as Patrick started out saying, why we want to go to all forms of all stuff, because it's, we know it all surely. It's because we have to keep on interrogating what happened in the light of our evidence, in the light of our interpretations, in the light of our understanding, to see how it happened, what was done, what the consequences were, what might have been different, and what is still challenging in our current circumstances and in our decision-making apparatus and our institutional design. So each of the themes that I want to pick up on runs at a not quite orthogonal to, but as David was suggesting, it's a slight angle, a tangent to Patrick's points. He asked this question about he raises this point about the importance of narratives and ideas and framing. And so I wanted to ask a question about the broader macro political narratives that conditioned the circumstances that led to the absolutely disastrous situation that the Irish economy found itself in at the end of the boom. And this opens out broader political questions about the challenges arising from the challenges of resolving the banking system crisis, which have to do with the institutional configurations of finance and politics and ongoing wider, what I think are ongoing wider weaknesses. And in the sovereign bank doom loop and its resolution, the distributive and political consequences, I think, do need to be maybe borne in mind and taken up a little bit more. Frankly, I think we probably move in rather different Dublin middle class circles, because nobody I know is saying the Irish are the best government in America. Never had, whatever. Well, a different narrative from my neck of the woods. But there were many narratives, of course, and that was certainly one that we heard in a certain period. So the first question about the political narratives that underpinned the weaknesses that we see in the whole banking system, it seems to me, deserve to be pulled out some more. And they're primarily around this whole narrative that the boom is getting boomier, that this growth is a wonderful thing, that the boom more or less will never end, that there'll never be a hard landing. So that, it seems to me, it was a very prevalent political narrative. And I think that the work of people like Akerlof and Schiller on animal spirits and rational exuberance, and Schiller himself on the power of narrative, is really useful and has generated a lot of interesting work in political science as well on the power of ideas, on the sort of the ideational circumstances of the stories that are told that justify political choices. And they can't be subtracted from the wider things that are going on in the economy. And of course, as Patrick points out, all of this started, the weaknesses started, the zip started to unpull with Ireland's accession to the euro. The disciplines, the wage disciplines, wage cost disciplines of the 1990s, social partnership and the ambition to achieve the Maastricht convergence criteria and so on, kept a rising market. We see rising house prices from 1995 on. But the sort of disciplinary pressures in the Irish economy and cost containment were pretty good, even as growth began to take off in that first phase of the Irish Baltic Tiger experience, through this concerted sort of social agreement about the terms on which adjustments to the new regime would be managed. But once accession to the euro was successful, then the external disciplines were gone. Not only that, it wasn't just that, it was the fact that so many perverse incentives swept into the system. And there was, I think, really relatively little institutional or political preparedness for what was then experienced. Many people were very wary of entry to the euro. Signing up to the Maastricht Treaty looked like a very good deal at a time of volatile exchange rates and uncontrollable externally driven inflation and exacerbating large-scale inflation and getting out of the mess of the 1980s. There seemed to be like in Italy, sort of a vincolo esterno that Ireland would latch onto to stabilise the management of the Irish economy. And so it seemed during the 1990s. But the cheap interest rates then that swept in were in a sense a kind of a resource curse. Cheap finance turned out to be a kind of a resource curse for the Irish economy. And resource curses notoriously pollute economic incentives. The funds are much easier to absorb into the easy generating areas like finance and property and housing, rather than in long-term productive investments. They tend to corrupt the political system because they distort the incentives. People misunderstand what's going on in how well the economy is doing. The institutions get corrupted, you get planning corruption, literally corruption, but the quality of the institutions deteriorates under these sorts of pressures. And the ideological or the ideational environment becomes contaminated by all of this. And what you get then is a narrative that says that the growth model of export-led growth, which Ireland had been pursuing consistently kind of since the 1950s and was producing new growth, genuine new growth, you might say, in the 1990s, was stalling. So here was a wonderful new way to generate new jobs. We were seeing a shift over to debt-led, consumption-fueled growth, and it was producing more jobs. So what's not to like? So this is all a good thing. We can make more money by digging holes in the ground, building houses and selling them to one another, and bringing in more people to dig holes in the ground to build houses that they can then live in, etc. And then this thing would be self-sustaining. So the narrative that there would be never a soft landing, despite the evidence of people like Maureen Kelly and warnings, and very muted warnings from all the international commentators and so on, were not heard because the official ears were stopped up by the wax of the perverse incentives generated by this whole system they got themselves locked into. And this turns out to be a self-reproducing sort of circle of delusion. So there's been a lot of work done on the narratives we see are also very evident in the international domain. The international markets are a subject to distorting narratives, and this is where Schiller and these people were working on in the first place, what they're working on in the first place. For example, the narrative that Ireland was the Celtic tiger, that the boom was persisting through the 2000s, persisted until quite a late date. And even the slow, construction itself peaked in spring 2007, and the banks were already, as Patrick has shown us, in real trouble. And the so-called St. Patrick's Day massacre on St. Patrick's Day 2008 really brought that to but that didn't really dent the image of the Irish government and of the Irish sovereign debt on the markets. And then just as irrationally, the global markets got spooked and their confidence in Ireland got rattled by imagery and emotions, even before the hard data was available to them. And Patrick has shown us the domestic data that was driving this deterioration in the performance. But in fact, from some work that I've done myself with a colleague, it was in fact, I seem to recall, Greece, that really was what absolutely spooked the markets. It was the fear of contagion, and the imagery of the change in animal imagery, I think, is very indicative. From being a roaring Celtic tiger to being one of the pigs, it's much less attractive animal imagery, and it's it's like it tells something in itself. So this leads us on to the question about the institutional configuration within which this delusionary, as we can now see in hindsight, world kept perpetuating itself. My second point, the weaknesses in the system. Well, Patrick has told us the story about the commercial banks themselves that were on more or less autopilot. It was a relatively provincial, uncompetitive banking system for a long time. Banks were latecomers to providing mortgage loans. They were used to generating strong profits, and they had very poor internal risk assessment capabilities. And the stories are well told now about the pillar banks being blindsided by these apparently more adventurous banks entering the system and making what seemed to be supernormal profits on property lending. And coming under enormous pressure, the boards themselves coming under enormous pressure. Look at Anglo over there, look what they're doing. AIB was venturing maybe a bit faster than Bank of Ireland into this terrain. The shareholders were saying, these other banks are making huge profits, why aren't we getting dividends? Why aren't you being a bit more adventurous there? And so they got lured into more risk-taking than they were able for. So with Anglo and IBS taking the lead there. The scale of the state exposure cross-nationally varies with the ability of governments to engage with banks collectively. We see this, and we zoom out, we can see this cross-nationally. And so we have to ask questions about why the banks had so little engagement or knowledge of what was really going on, and why nobody seemed to have, as Patrick's pointing out, until a very late date, actual loan by loan knowledge about the exposure of the banks. Work by Cornelia Wall and other people has shown that strong structured engagement by the state with the financial sector resulted in the states being able to force industry resolution. And Denmark and France turned out to have the best capabilities in this regard. But where government didn't have those relationships, where the whole system was more or less on autopilot, and where banks were having to be dealt with one by one on a case-by-case basis, that's where you get the really serious liabilities incurred by the states, and Ireland and Britain ended up. Certainly Ireland did it very badly in this regard. But as Patrick points out, the seeds of all of this go back a very long time. And on the night of the bank guarantee, the scale of it was so profound that they simply went and there was no time to generate the kind of legislation that they'd had already in place. They were able to take action in Denmark early in 2008, for example, because they knew really what was going on. And so behind this, then we see, I think, much more worrying weaknesses in the nature of the institutions of Irish democracy. As political scientists, we tend to be very preoccupied with things like the party system and obvious deficits in areas such as cronyism and corruption in managing public assets. But behind this, weaknesses in institutional capacity for economic steering, very passive institutional design, were very problematic. We now know in hindsight that the Department of Finance didn't have a lot of highly trained economic expertise, and they've been busily grouping around this and getting more professionally trained people in since then. That's not to say that it isn't a very capable people, and the kinds of economic modelling and projecting that we've seen was very accurate, and the planning preparatory to the loan program was all done in-house. Essentially, the loan program, as you know, was mostly homegrown and home-generated. There was a lot of expertise there, but really thinking hard about where the deficits were in institutions, I think, came late, and is still, to my mind, very incomplete. We know that independent commentary was weak or missing, and it's Kieran Casey who has done a lot of work on this, the historian here in UCD. And we now have an Irish Financial Advising Council and so on, which we didn't then. And the ability, the state's ability to see is what's your man's name, Scott? This seeing like a state. A state needs to see what it is to govern or make decisions about, and for that it needs data, it needs information, and so statistics, data, knowledge. These are key state requisites. Somewhere in Patrick's work, I learned that there were only 8 people working in central bank regulation in 2010. So the knowledge capabilities are very, and we know how when there was a weak regulatory financial capacity. So these were, I know, partly deficits in the design of EMU, where national level regulation was assumed to be on its own footing without ECB research taking its hands off it. But these were national responsibilities, and the court very much last time. But the wider institutional weaknesses and their legacies, it seems to me, remain. And it seems to me that in the sort of the rush to build capacity for the state at large, the way it has been done is not necessarily best for building up the best kind of abilities within for the state, because within the state itself, what I have noted is a kind of a hollowing out of information capacity. There's an awful lot of outsourcing of information and consultancy to the accounting, business advisory, business consultancy firms, instead of building up in-house expertise, real expertise in the public service itself, and consolidating and sustaining blocks of expertise in functional areas with policy development. And we see this in our really quite problematic capital project implementation, planning, development, implementation, delivery, huge cost overruns. There are better models, and they do require building up systematic expertise within the state. I won't go any more into that right now, but because I want to leave too long. But the third thing is that under this heading of institutional weaknesses, the stop-go and housing policy was an absolute disaster, as we now know. The contractions, the austerity contractions, too intense across Europe in general, but the decisions made at that that early point, and the ongoing way in which the recovery has been managed, still show, it seems to me, disjointed, a failure to have joined up thinking across all the areas of economic management recovery, financial management and recovery, and the wider arena of the society for which all of this is actually being done. So, and this, particularly in a housing situation where reliance on owner occupancy has been such a fundamental part of housing policy since before that had been the foundation of the state itself. What we're seeing now is still a totally neglect, but still kind of piling on of policy initiatives and piecemeal policy making implementation, amplified by this inability of or weakness in imagining a kind of more robust engagement of the state and state capabilities and state institutional capacity in driving all of this. And I think we still see weaknesses in budgeting. We see the IFAC certainly, but its voice is sometimes a voice in the wilderness, and multi-annual budgeting, we know, is lagging behind other countries' practices, and we know that there are problems about the frothy foundations of a lot of the revenues that we're seeing now, which for very young people like me and perhaps one or two others in the audience are reminiscent of frothy property revenues just for the crash. We're certainly worrying. And thirdly, then, on the bank sovereign doom loop and its resolution, and the broader implications, then, the distributive and political consequences. of course, there were different kinds of banking failures all across Europe. 20 and more of them, apparently, in the decade 2007 to 2017, for those with common vulnerabilities, failures across the system, failures in the design of the EMU, of course, all of those things. And we know that the responses of the ECB, the slow responses of the European authorities, and a lot of punitive approach taken by the ECB for a long time and so on, were very culpable. In the story that Patrick tells, I get a sense of a kind of necessity. It's a rather dispassionate and clinical approach. And he says, and then we went into the loan program. But I remember very well the sense of absolute shock and dismay at losing national economic sovereignty. This idea that I remember Kevin O'Rourke blogging and writing on social media, just being stricken to the core of his being, and this idea that the whole trajectory of the national independence project was now so grossly compromised, and it is in fact a terrible failure. And for all that, we have to note and welcome the fact that Ireland recovered on the key metrics much faster than the other countries got out of the other loan programs. It's still something that poses a great many questions for us, and ongoing questions about how it happened, why, and what sort of society we're managing, and what we're doing going forward, and what we need to mend things. And the long-lasting social and political costs are still very palpable, it seems to me. Behind the successes, for example, of Niamh, the wider unequal social distribution of burden sharing is still very much to be seen. The successful fiscal adjustment, as Patrick noted, front-loaded and spending cut-based and so on, and the remarkable successes in keeping the social welfare payments going, and Joe Burton's endeavour to keep the rates up to protect the most vulnerable and so on. The spending cuts still were also brutal and long-lasting, and we can see them. And I'm delighted to see that slide there, the cumulative impact of austerity relative to the 2008 budget. It's not to say that we debate what alternatives might have been possible, but it is to note that the quality of existing services declined, and the people who are the most dependent on welfare are, of course, the most vulnerable. But there are also enormous deficits for the wider society, where social services were at the point of being built up for the sort of social investments that are needed by everyone in the society, reforming the health services, most obviously, building up primary care centres, improving access to affordable childcare. So many of the social investment welfare state agenda items have been really lagging, and we know that investment in infrastructure on all fronts in Ireland is woeful for our level of wealth. We know that the IMF has said we're lagging way behind on transportation, on energy and green transition, all those things. So, and ultimately and finally, it seems to me, and a slightly intangible, very real cost of the crisis and its aftermath is electoral disillusionment of the political system at large. We see the kind of instability, the volatility of the party system, but a wider political disillusionment that is in large part ongoing. So, thank you very much.
We have our second vote of thanks from Professor Karl Whelan from the School of Economics in University College Dublin.
Thanks, Paul. So I want to thank Patrick for writing and presenting this paper. I particularly want to thank him because I was supposed to be there in Sweden chairing his panel, and I got sick and I couldn't go. So since it gave me a chance at a second bite of the cherry, might have said this much in Sweden. Okay, so the Irish banking crisis generated a lot of controversy at the time. But I think it's now long enough that a calm and dispassionate analysis of the events can be undertaken. You'll find I'm going to say some things that Niamh said as well, use a very similar phrase. And Patrick is a great man for providing calm and dispassionate analysis. I'm perhaps less well known for these qualities. So my comments are probably going to be a bit less charitable to some of the participants in this crisis than Patrick has been. From today's perspective, I think it's important that we understand the lessons from how Ireland's public service and political leadership responded to this crisis. There's a wider set of issues about how we got into the crisis. I'm going to focus here on the response. Now, Patrick is in general relatively forgiving in his assessment of this policy response. I would characterize his assessment as that mistakes were made in responding to the crisis once it emerged, but that the outcome would have been pretty bad, even in a best case policy response, thus limiting the real impact of these mistakes. I've written that here, but I think Patrick pretty much said something like that at the end here. So I think this is perhaps a bit generous. And it's hard to run counterfactuals, but I think it's perhaps a bit generous. From my reading Patrick's paper, a key theme that emerges time and again is that once the problems in the banking sector emerged, rather than attempting a substantive analysis of the scale of the problem and potential scale of the problems, Ireland's leaders largely preferred to engage in a sort of magical thinking and had a belief that bluster was going to be a very effective response to the problems that they faced. Patrick wrote, the authorities should have realized that these banks were deeply insolvent, but they did not. This was not a small failure. Okay, we'll step back for a minute and think about the implications of this failure. There were plenty of reasons on September 30th, 2008, to be extremely concerned about the state of the Irish banks. It didn't require a lot of knowledge of international banking history to know that commercial property busts had been ruinous bank for bank solvency in various examples. Not that one, you didn't have to go far back in Sweden. Nordic banking crisis and the events of Sweden, the savings and loans in the United States. This was a common pattern, and we should have been attuned to it, given that, in Brian Lenihan's own words, the property market had come to a shuddering halt. Share prices for banks are not a perfect measure of measuring the equity capital of a bank, right? Those of you here from Econ 30150 will recall me talking about book value and market value and so on. But the fact that the share prices of the banks had collapsed and had collapsed months prior to the guarantee decision was a very strong signal that financial markets had believed that the banks had lost all their capital. There were ghost estates already all around the country by September 2008. The day after the guarantee, Morgan Kelly of this parish was on prime time, and he was asked what he thought about the guarantee. And he said, and I'm not going to attempt an impression here, he said, all the ghost estates you see around the place, that's the capital of the Irish bank. So this is not 2020 hindsight, that perhaps they should have had a better understanding. Patrick's paper also gave me a better sense than I previously had about the sequence of events that led to the September 2008 guarantee and the closing off of other options. The central bank were clearly unwilling to contemplate the scale of the impending insolvency problems for the banks, because this would have required admitting a catastrophic supervisory failure on their part. The idea of introducing bank resolution legislation was considered and rejected, because passing it would have suggested that some of these banks were in bad shape. And that ran counter to the messaging that the banks were grand. An alternative to the guarantee in September 2008 would have been that the central bank could have extended emergency liquidity assistance, something which it did in very large amounts not too much later. This was new to me. I didn't know this. I'm sort of consider myself a collector of stories about the banking crisis, but I didn't know this. Patrick tells us that this was considered, but it was rejected because Northern Rock had received emergency liquidity assistance. And the authorities didn't want anyone to think that the Irish banks were maybe as bad as Northern Rock. Of course, the reality is they were much, much worse than Northern Rock. Poor old Northern Rock, they were a bit unfortunate, much as anything. Now, even with all these other options ruled out and the decision to go for a guarantee, you can see the faith in bluster in the design of the guarantee, because the downside of it was it essentially maxed out on potential losses for the taxpayer. So what was the advantage in designing it this way? Well, it took the bluster strategy to the max. It said, we're going to show the world how much faith we have in these banks. We're going to guarantee the whole thing. That was the only criteria along which this was a well-designed initiative. After the guarantee, the bluster strategy was continued. Admitting that the government had put the taxpayer on the hook for enormous losses wasn't politically feasible. So for at least 12 to 18 months afterwards, we had enormous amounts of denial and obfuscation from the government of the day. Tons of political capital was expended saying that the Irish banks wouldn't be nationalized because this was unthinkable. Ireland, we're a wonderful country and we have lovely banks. And we're not going to nationalize our banks. That's totally unthinkable. And of course, in the end, the banks get nationalized. Bondholders losing money. If any bondholder that was owed money by an Irish bank lost money, apparently that was going to be the end of it for the country. These were all, you know, ultimately misleading people because the government had put itself on the hook in relation to the guarantee policy. Of course, we know that today, bondholders in failed banks losing money, that's official EU policy, right? So it's not just me that thinks that was bluster. I think you could also question whether the Irish government might have been better off to request an EU IMF program far earlier than it did. Right? Patrick talks about the dialogue of bad but manageable. But maybe we might have been better off saying, very bad, not manageable, you need help. Most of the bank run that ended up with the enormous accumulation of emergency liquidity assistance provided to the bank happens, as Patrick mentions, during 2010. And there is, and this is maybe very much is with hindsight, there is an argument that perhaps in 2010, Ireland should have negotiated a deal with the IMF and the EU to borrow the money to recapitalize the banks and started that process earlier from a position where there was a less of a reliance from the banks on the ELA. Now, of course, if you try to rerun this again, as Patrick points out, the signing of the program on its own didn't just suddenly magically restore faith. And the money kept going out of the banks for a number of months afterwards. The key moment, I think, I'd be interested to hear Patrick's thoughts on this, the key moment that I saw in terms of restoring faith in the banking sector was the publication of the PCAR type exercise in 2011 that went deep into the banks and was much more granular than anything people had seen before. But maybe if we'd had a PCAR in autumn 2010 instead of spring 2011, the whole thing mightn't have been so bad. So look, from today's perspective, the question I'd ask is whether our policymaking structures are placed or have a better place now to avoid the kind of magical groupthink that we saw in response to the banking crisis. Now, I'm somewhat optimistic that Patrick's term as central bank governor and the reforms to that body mean that it's has a culture with a greater skepticism towards financial institutions than it did previously. I think it's better resourced. I would like to think that it's better positioned in terms of there being more honest exchanges of opinion within the organization. I certainly know people within the central bank that didn't believe the things that the central bank leadership said about the state of the banks or the property market. Beyond that, I'd be a bit less optimistic that the policymaking structures of our civil service, our government or our politics have really substantially changed since the crisis. So I don't think the IGs is going to save us all from poor reactions to crisis or poor decision making. So I'm not sure. And of course, the next crisis, probably won't be the banks, right? Because it's barn doors and all of that, right? But I'm not sure our national character or our policy-making structures have changed sufficiently for me to have confidence that we will always react well to crises in the future. Last thing is, I'd like to say a few words about the ECB, and this will pick up on some of the things that Patrick said. So as Patrick described, the way the central bank provided funds to the bank in the form of ELA required the ECB Governing Council to approve. The whole process is just labyrinthine in its complexity. Technically, the central bank issues the ELA, not the ECB. The ECB doesn't vote on it in its normal fashion. There's this Article 14.4, which means a 2/3 majority of the Governing Council can stop the ELA. Either way, ultimately, the ECB has to approve it. And from early 2010 onwards, you started to read stories in the bank that made it clear that certain ECB officials in Frankfurt were unhappy with how much money was being extended to the Irish banks. There was talk about addict banks and things like that. It was all a bit new. And in terms of the timing of the program, I think it's had an enormous influence on the attitude of people in Ireland and subsequently other countries in terms of how they think about the ECB. Patrick's papers ultimately says, the Irish authorities realized that the program was the best option. But the public recollection of this, by and large, is that the ECB shoved Ireland into a program. Right? That the message that was in the letter that Jean-Claude Trichet sent on November 19, and the dates there were very important. November 19 was after the government had essentially said it was negotiating the program. Patrick had already been in Morning Ireland. So officially, it's just a sort of after the Lord's Mayor show sort of a thing. In practice, I think most people believe that the message from the letter had been given in the preceding weeks in some format or another. And the message included not just that the banks needed to be restructured, and we can understand this, the ECB is providing enormous amounts of money to banks in a situation that seems to be out of control, but also that the Irish government should engage in fiscal consolidation. They should engage in structural reforms. It was always very interesting to know what structural reforms the ECB thought. I used to say to the ECB, we can shop on a Sunday. Maybe you guys should consider structural reforms, right? And the result of all this was that the ECB's role in Ireland's crisis became highly politicized. Now, that was not least because of their subsequent preferences about repayments of bank creditors. Patrick is correct that these were not, in the end, game-changing amounts of money. But, to the public, anything ending in billion sounds like a lot of money. And knowing that the ECB went into bat for bondholders in failed banks left a sour taste for many. We also know their preferences in terms of the design of the program was to be more aggressive in both terms of fiscal contraction, but also in terms of how fast the banks themselves could contract. And it's not clear the ECB were particularly realistic at that. And unlike, I think, other programs that have happened elsewhere, this particular program, the officials leaked like a sieve, right? So both the EU and the IMF did a lot of talking with people around town and got their sides of the argument out. But the IMF were much, much better at it than the EU, than the ECB. So, I mean, to this day, the IMF officials are literally amazed they walked away from the Irish program as the good guys. Now, I'm also still unclear what part of the ECB's highly defined legal mandate actually requires it to make its lender of last resort activities contingent on things like structural reforms. I'm not quite sure why they decided that this was their bailiwick. And Ireland wasn't the ECB's last rodeo. There's similar drama and worse surrounded the ECB's withdrawal of threats of withdrawal of ELA, and actual withdrawal of ELA, right? In both Cyprus and Greece, where the banks literally closed for weeks on end. So despite being an organization that ostensibly strives to be above politics, the ECB entangled itself in a series of very highly politicized controversies. Now, could this happen again? Bad things and good things. There's points you could make. The bad things is the ECB's procedures in relation to ELA and the 2/3 majority and all of that, and it's still there. It's still sort of opaque. It's still kind of cumbersome. On the good side, the hope for avoiding these kind of problems lies in the use of the resolution tools that were brought in by the Bank Resolution and Recovery Directive, BRRD, in 2015, and the hope that these kinds of tools, purchase on assumptions, losses being inflicted on creditors, and so on, that these will be the way that failing banks will be approached before they ever get to needing enormous amounts of emergency liquidity assistance. So that's the hope. As Patrick noted, each of the Irish banks in 2008 would most likely meet the criteria in the BRRD for failing or likely to fail. And so each of them, if it was today, the Irish government's approach to dealing with failing banks, it would be illegal. It would not be allowed to do this according to European law. And the banks would have to go through some sort of resolution process, which would at least start by inflicting losses on creditors and limiting the cost for creditors. I guess my concern about BRRD, my final comment, is that BRRD's tools are fine for sort of showing up on a Friday afternoon at a random institution, right? So Banco Popular got the booby prize of being the first bank that got the Friday afternoon FDIC purchase and assumption treatment, and it works great. But I'm less sure about the process of if we start to go through another multi-country systemic banking crisis, that BRRD are going to show up at 20 major banks on Friday afternoon and tell everybody that all the bank creditors, these 20 major banks, are going to lose money. So I think at that point, all these issues around whether to extend the ELA and how long to deal with it and how long, whether to cut it off and all of that, and whether people should make programs, I suspect they're going to be back on the ECB's agenda. So that's what Whelan thought.
So I'm completely fired as chair. So what I'm going to say is those who have to leave can leave now, and same online. Well, I know there's plenty here who've already got a couple of pages to read out, both in the room and online. So I'll give you a couple of seconds, but maybe we'll take some questions online or hands up online. We'll just give it 2 seconds.
Thank you.
Thank you. So please, when you give your name and affiliation, and you can write your comments into secretary@sisi.ie afterwards, and so you don't have to come up and speak into the now.
Okay. Paul Sweeney, member of the society, and also a former trade unionist. Who I would like to say it was interesting, but it brought back a lot of bad memories. Meeting the Troika, which was not pleasant, and particularly unpleasant was the guy from the tall Hungarian. I can't remember his name. So I remember. From the ECB, I didn't know if he was a human, actually. I won't put that in my notes. 2 questions and then a couple of disagreements. The first question is, I remember the central bank was divided. There was a separate regulatory board made up mainly of the same people, but not quite all. I wonder if it had still been the one body, would it have been as bad as it was at managing regulation? That's the first question. The second is, also on regulation. Is regulation, I know it's been greatly reformed, but is it adequately reformed? We're seeing since this Silicon Valley Bank, Credit Suisse, or is it Swiss, whichever one of those Swiss banks, the other at one at the other. There's crypto, and there's a massive amount of shadow banking. And I, as a former trade unionist, every time a company we dealt with was taken over by a block of shares by private equity, it scared the life out of us because we knew all they wanted was cost reduction at any cost. They had no feeling for the business. I disagree with you, as you'd imagine. We didn't all party. I certainly, our members didn't. I know very few people who did.
I didn't say it.
Okay, fair point taken. Secondly, we argued in Congress for a slower recovery, and I do think it would have hurt the poor less. There's no doubt, and there have been some academic papers I've seen showing that austerity has a lot of bad aspects to it. And certainly, I remember being quite surprised in my job seeing how a lot of our members' companies, wage increases were coming in, but the place is in a mess. How come people are getting good wage increases? Of course, as the Americans do it, there was a division between Main Street and not Wall Street, but finance, property and finance. And that's what we're seeing. And I began to realize that multinationals and Irish indigenous companies, the dairy co-ops, the COH, they were all doing very well. They seemed to be, unless they were in the property-related business like Grafton Group or whatever. And I could see that, and I was optimistic. On the bailout, I certainly thought the government ran into it too quickly. The particular day, that afternoon, the minister spent the day with us, 2 hours of it. We delayed him going to meet the banks, and I always remember, he didn't bring one of my trade union colleagues in when he met the bank, because when they said, "We have a black bag we want you to buy," they would have said, "Well, open it so we can see what's in it before we give you a price," because it was madness. But I had a meeting with, a closed meeting with the IMF during the bailout. Trade unionists, it was closed, and I asked Christine Lagarde, should there be burden sharing? It was still going on, and she said it should. And of course, I was going to rush out and tell the world this, but I was told I wasn't allowed to say this until the crisis was over. But she said it to us and to lots of other trade unionists from different countries. And I felt maybe they should have gone and talked to Europe, because we're all in it, and not just the Irish people suffering the bailout, when Europe did amend themselves later on the bailout. But those are some comments. And thank you, very interesting data.
Thank you, Niamh. Yeah, John.
Thank you very much, Patrick. I was a member of the Oireachtas committee, which investigated this, and Patrick was the speaker whom we invited back twice, so he was so impressive. But the Irish banking crisis was caused, as Patrick's paper says, by a bank credit-driven property price and construction boom dating from 2004. Net foreign borrowing by Irish-controlled banks rose from 19% of GNP in 2003 to 64% in early 2007. Today, there are 3 Irish banks in the mortgage market, compared to 6 when Patrick was looking at it, and all the non-Irish banks have left the mortgage market. And Patrick's paper notes on page 21 that the ban, this has resulted in a much reduced rate of home ownership, especially among younger households. And that's the long-term consequence, I think. The the withdrawal of foreign-owned banks left an uncompetitive sector, charging relatively high costs to borrowers and offering low returns to savers. So that's the consequence which we still have to live with. The Wright report found in 2010 of the cadre of 542 staff in the Department of Finance had only 39 economists trained to a master's level or higher. 39 economists in the Department of Finance is extraordinarily low by international standards, they said. The commercial bank, the central bank and the commercial banks were criticized by Honohan for weak regulation and poor performance. The central bank imposed no fines on commercial banks during the boom years. Following an examination by the central bank of the cost to borrowers of being moved by the banks from tracker to standard variable contracts in 2015, the banks were ordered to make redress and were subject to heavy administrative fines, the total cost exceeding 1 billion. So we're left with a highly inefficient mortgage market with two lenders depending on over 50% of state finance, and all of the foreign lenders have withdrawn. Weak regulation of the banking sector allowed that sector to impose large costs on the rest of the economy, as Patrick has said. And that cost is seen today in a much reduced rate of home ownership, especially among younger households, according to the paper that we've had from Patrick. Where will the problem occur next? I think it will occur in the Irish health sector, which is technically carrying on in exactly the same way as bankers used to. And I leave you with that thought. But I think that's the next place. I think banking we have sorted reasonably, but the health sector is completely out of control, as the attempts to formulate a budget for next year have shown. Thank you very much.
So maybe just one last comment, because we'll certainly finish at 7:30 on a hard stop. Okay, so you'd like to name filiation.
Thanks. Yeah. Did I speak into this thing?
You're grand there, yeah. You're grand.
Sorry, I'm Pat McCardle, and I should declare that I was the chief economist at Ulster Bank at the time.
Yeah.
So, although I retired shortly afterwards, but it has been an interest. Just a quick comment, first of all, on the last two speakers, and as regards, I'm sure a lot of trade union members bought houses at prices they couldn't afford. You know, maybe Paul might like to think in that. And the other thing, I was called before the bank inquiry, as you probably know, and I said, and I was a member of the Wright report as well, in the Department of Finance. I was very conscious of the number of economists in the Department of Finance because I had been one there for 20 years. And there may be a figure of 29 in the report, but there certainly weren't 29 economists in the Department of Finance. I counted them and I got one. In fact, I got less than one because there was one guy there and he did other things. There may have been 29 people who had trained as economists at some stage in the distant past, but they weren't acting as economists. Wright was very hot on that. Anyway, to come back to the main point, as Patrick said, it's a very complex and multifaceted topic, and I can only perhaps look at one aspect of it. And Patrick is ideally positioned, of course, to comment on a lot of it, which is why we're hearing new facts even at this stage. But the one thing which I think all reports and inquiries into the banking system didn't really get to grips with is the failure of regulation. Now, we all know the regulator failed, but we know it in a very general way. For example, if you're at global level, it failed. Basel II allowed large banks to introduce their own funding, their own models to calculate their liquidity. And at one stage, it was around a crisis, it was large banks had less than 1% capital ratios. That wasn't the case in Ireland, but that gives you an indication of, it was a global issue here. There was a failure of regulation in Ireland too, even though the capital levels were higher. And I just want to give you a perspective on that from the position of someone, I was an economist in a bank, so I wasn't an actual lender. I wasn't interacting, well, I was interacting to a degree with some of these developers because they thought they owned the bank and they thought they owned me as well, and I was their private economist. But that apart, the way I see it is we had virtually no regulation, arguably at global level and certainly at local level. And we've now gone to a situation where we have arguably excessive regulation in some respects. I spoke recently to a guy in head of credit in one of the banks, who should be nameless, and he said, I asked him how's he getting on. He said, it may not be widely known that, it's Frankfurt calls the shots now. Basically what he told me was he can't go to the toilet without getting permission from someone in Frankfurt, which is not a good situation either, And the Irish banks, by the way, why have we only got 3 domestic banks left? It's because the foreign banks end up in a situation where they couldn't make money here. So they pulled out, which is not good either. And you can see, in fact, it's very, very bad. But to come back to the point, how did this lack of regulation work in practice? This is really, I suppose, the one thing I want to say tonight. It worked like this. We had competition. In fact, arguably we had excessive competition in banking at a certain stage in the just before the banking crisis. I went to Malta and gave a talk on this, and the Maltese were absolutely shocked at what was going on in Ireland, in the sense of how narrow the margins had become, how many competitors there were, how many mortgage providers there were, etc., etc. I remember it vividly. But the way it worked was this. There was a comment passed earlier about the number of regulators in the central bank, which was definitely very low. But the one thing that happened and was allowed to happen was Anglo-Irish was allowed to become the best bank in the world. And how did that happen? It grew by 36% per annum for, I don't know how long, I've forgotten, probably a decade, let's say, but it was arguably less. So imagine growing an organization at 36% per annum. It is phenomenal. That had severe consequences. And so that should not have been allowed and would not be allowed today, I think, under the rules and regulations that are there, whether they're excessive or not. Just as excessive lending for mortgages wouldn't be allowed today. And the recent rules have by and large been very successful. But that failure to control or curb Anglo and nationwide to a lesser extent had very significant knock-on effects. And I know this because I would talk regularly to the people who are lending. It meant in effect that if a developer didn't get his funding from Ulster Bank, he could go down the road to Anglo in the certain knowledge that he would get it. Now, that meant that, for example, in terms of credit, if you borrow from a bank a large amount, you have to go through a thing called credit committee, which is a committee of wordies from the bank, frequently from the back office, who make life difficult for the lenders, right? Which is their job, it's checks and balances system. Irish nationwide credit approval process took about 10 minutes. You might have thinking inside it. Anglo-Irish could turn it around in about 24 hours. And in Ulster Bank, it took 2 weeks because there was a credit committee in Ireland to go through and another in Edinburgh. So you can think about that for a moment. And these developers were not people to wait and around, etc. So they came into the banks and they said, right, if you don't give it to me, I'm going to get it. And to answer Pat's question, why were there no documentation? Why were there no valuations, etc.? The reason was these guys said, oh, we're off, we're not giving it to you. I remember one guy who subsequently became famous or perhaps infamous, and the lenders in Ulster Bank spent ages trying to wrinkle out of him a statement of his net worth and his assets. Eventually, he drew out a piece of paper and scribbled the figures on it in about 2 minutes as the back of an envelope approach, and that was it. And of course, he may have left out some loans to other banks. That's why they didn't know. But that didn't matter because the lenders in Ulster Bank knew that if they didn't lend to him, he'd go down the road. Now, this process was called, they're taking our lunch and we're going to take it back, famously attributed to the chief executive of AIB, but denied in the bank inquiry. See, if your competitor is going at 38% or 36%, you're losing market share. So you've got to decide what you do about it. But the logical thing would be not to get involved with these excesses. But then it's a bit like the herd or the lemmings. If you're in a herd of wildebeest heading for the river You know, if you stay in the herd, there's a good chance most of you will cross the river safely. But if you leave the herd, you're isolated, and the lions will for sure pick you off. So the bank executives in Ireland, they chose to stay in the herd, A, for that reason, because the alternative to them was to lose their jobs. Certainly in the case of Ulster Bank, if you were dealing with Shred, who's someone you may have heard of. But in the case of 2 Irish banks as well, they had to go to New York on fundraising trips. But they met the investment people, and they would say to them, well, how come you're not growing at 36%? Why should I put my money in your bank when I can get pushed in the #1 bank in the world, which is Anglo? So that was the dynamic. And that is why now I had no idea that the bank's documentation was so bad. They simply didn't have proper documentation, and Niamh made them pay dearly for this. It didn't pay for any loans that were properly documented. So I reckon we're coming to the end, I should speed up a bit.
No, so others have to have.
Oh, sorry. I also have to go, well, then I'll leave it at that. I was going to say something about Niamh and exuberance and various things, but I'll leave it at that. Thank you.
3 minutes. Are we done? Oh, no, okay.
Actually, maybe a quick question. Yeah, maybe. Couple of questions. No, I find it was fascinating presentation. Actually, this one is you said that the alternatives wouldn't have been that much better, but maybe it just wasn't actually what was at the time what would have been the so much better alternative. Then just on the bank regulation or lack of it during the boom, in your report, the banking report you did some years ago, there's one footnote that caught my eye where he said if there had been the better regulation, it seemed to say that better regulation wouldn't have stopped the boom and bust, the property boom and bust would have saved the banks. Well, if there was better regulation here, if other banks, foreign banks might have done some of the lending, and you could still have had the property boom and crash without the banking boom. But it's just wondering if I'm reading that footnote right or not. But the impact on the property if you had better regulation.
Okay. Thank you. So could I suggest that people write into, I think there's a lot of people which, want to go back in time. So the secretary at SSISI.ie, which I have up online there, but also people know here. If people write in, Patrick, you'd answer them, would you? Would you continue?
No, certainly will.
Yeah.
We have decisions like that.
And do you want to answer something? Is there something you want to give your writer replies or anything you want to really say? Or?
I just check out 3 or 4 points.
Yeah.
Interesting point from Karl. I think it was Karl saying, should there be an early IMF? Gone to the IMF 6 months earlier. They did suggest it. They did come and they said, or they said on the phone, what do you think? And I said, that's a great idea. Talk to the Minister for Finance. That was the end of that. And to do something like this, you have to create a political environment, and the politics wasn't there. Realize that things are sufficiently bad that we will need this hope. So, and as you say, a bluster is a great word there. Actually, what really was wrong with the program, and it wasn't within the capacity of any of the lending organizations, what they should have done, the big uncertainty surrounding this thing was how bad was the banking hole going to be. And to solve that problem, the European funds should have injected capital into the banks and not lent to the government. Because just lending to the government means, well, we're not sure if this is going to be enough, and if it's not, you're going to fall again. They said, okay, we'll look after the banks. They would have made a lot of money. But they didn't. They didn't make a lot of money. The ECB, does it have these legal powers? Very, very doubtful that it's, certainly it's obiter dicta or way beyond its normal mandate. And a lot of people subsequently said, we ECB don't want to get involved in any of these programs ever again. Paul Sweeney asked whether if there had been separate between one bank, would it have solved the problem? Probably not, but it certainly created that ambiguity that the central bank is in charge of the macro financial side of it, and then the regulator just looking at the individual bank, and they didn't really talk to each other adequately. It certainly wasn't a good model, but it wasn't the only sort of the problem. There was a thought at the beginning, immediately after the bank crisis, the government said we're going to change the law to bring them both together, as if that would solve the problem, but it wouldn't have solved the problem. Has regulation and supervision improved? Read the Federal Reserve Vice Chairman Barr's report on the SVB, Silicon Valley Bank. Very nice report. It could have been lifting paragraphs out of my own report and other reports. It's a shock to find that the American supervisors are making the same mistakes as we made in the 2008, 6, 7, 8. Austerity, a little bit clear about the austerity, and that, you know, would it be more or less. In the end, the governments have to pay their way. Nobody's going to give them a gift. So the question is, how fast would you make the adjustment, not how much the adjustment would make. So I absolutely agree that austerity is really, I think some attempt was made to lessen the burden on the poor, but it's still the poor people who get hit most. But the question that I raised is, if by doing it faster, would you get everybody out of it faster? However, I'm glad I didn't prevail on that, or I wasn't in the debate on that. That wasn't my role. But I'm glad that they didn't sort of speed up, because by 2015, suddenly all the corporation tax came in. Look, ooh, it's all right, no fiscal problem anymore, which is quite extraordinary. Noel's question about a footnote. I can't remember the footnote, but I think probably the issue there was, one of the arguments made at the time was, we'll have to let the Irish banks do this lending, because sure, they lose market share to the foreign banks. The foreign banks will do all the lending, and we'd be only damaging our own banks. But this concept of our own banks was problematic. Our own banks are the ones we had to pay for. And yeah, the foreign banks, they would have to pay for, and they did have to pay for it. I'll leave it at that.
Thank you. Okay, so just one brief announcement. So our next meeting is December 7th by Professor Frank Barry from Trinity College Dublin. And it's a cohort paper on the regional location of indigenous and foreign manufacturing establishments, 1929 to 1979. So with that, I thank everyone for coming online and everyone who's been here today, and I will see you December 7th.
Thank you.